Picture a prosperous town in medieval England, somewhere in the 12th or 13th century, a place where the market square is busy on trading days, where cloth, wool, spices, leather, and grain change hands in transactions that look simple on the surface, but are governed by a surprisingly sophisticated set of rules, relationships, and institutional arrangements sitting underneath everything. At the center of that commercial world, controlling who can trade, on what terms, at what prices, and with what protections, sits the Merchant Guild. From the outside, it might look like a social club for wealthy traders, a brotherhood of successful men gathering for feasts and ceremonies, wearing distinctive robes and conducting elaborate rituals. But the economics of actually running a medieval merchant guild were far more complex, far more commercially purposeful, and far more consequential for the towns and regions they dominated than that ceremonial surface ever suggested. Understanding how a guild actually worked as an economic institution means understanding something that the modern world has largely forgotten, which is that markets do not organize themselves naturally and cleanly. They require infrastructure. They require trust mechanisms. They require enforcement. They require quality control. They require capital flows and credit arrangements. They require dispute resolution. And in medieval England, before the state had developed the administrative capacity to provide most of those functions reliably, the Merchant Guild was the institution that provided them, charging for that provision in ways that made membership economically essential for anyone who wanted to trade seriously in a town where a guild held its charter. If you find this kind of deep dive into how economic institutions really worked behind the scenes genuinely fascinating, follow Money Framework British, because this channel is built around exactly that kind of serious, clear analysis. Start with the charter itself, because everything about a guild's economic power flowed from a single foundational document granted by the Crown or a local lord. The guild charter was a legal instrument that gave the guild the right to regulate trade within a defined geographic area, typically a town and its surrounding market catchment. In practical terms, this meant the guild could determine who was permitted to trade wholesale within the town, enforce standards on goods being bought and sold, collect dues and tolls from members, and in some cases, from non-members trading in the market, and exclude outsiders from the most advantageous trading conditions available within that jurisdiction. The charter was not merely ceremonial, it was a monopoly instrument, and the economic value of holding one was enormous. The Crown granted these charters because it benefited directly from doing so. In exchange for the monopoly rights the charter conveyed, the guild paid a fee to the Crown, often a recurring annual payment in addition to an initial grant fee. And in return, the Crown received a reliable, organized commercial class capable of generating taxable trade, maintaining market order, and providing loans or financial support to royal projects when required. This was a genuinely transactional relationship. The guild paid for its privileges, the Crown received revenue and commercial stability, and the merchants of the town received protection and market control. Understanding this triangular relationship between Crown, guild, and market is essential to understanding why guilds existed and why they were so economically durable. For the centuries they flourished, the membership economics of a guild were built around a tiered system of entry, obligation, and privilege that was considerably more sophisticated than it might first appear. Becoming a full member, a freeman of the guild, typically required either serving an apprenticeship under an existing member, being born as the son of a member and completing the necessary formalities, or in some cases, purchasing membership outright with a cash payment called a fine. Though this last route was generally more expensive and carried somewhat less status than the apprenticeship route. Each of these entry paths served the guild's collective economic interest in different ways. The apprenticeship system ensured that craft knowledge and trading relationships were passed down in a controlled manner, maintaining quality standards and preserving the value of existing membership. The hereditary route built generational loyalty into the institution. The purchase route generated direct cash revenue for the guild treasury, while allowing occasional controlled expansion of membership when the guild judged that the market could sustain additional full members. Once inside the guild, a full member gained access to a set of economic privileges that were genuinely substantial. In towns where a guild held a strong charter, only guild members could trade wholesale in the most valuable commodities without paying additional tolls or facing restrictions on the quantities they could buy and sell. Non-guild traders, referred to as foreigners, even when they were English, but simply from another town, could be required to trade only through guild members as intermediaries, effectively paying a tax on their participation in the local market by making a guild member's involvement economically mandatory. This created a sustained revenue stream for guild members simply by virtue of their membership status, not because of any particular commercial skill, but because the institutional structure placed them between outside traders and the local market. The guild's treasury and financial management represented one of the more underappreciated aspects of the institution's operation. The guild collected dues from members on a regular basis, typically annually, and these dues varied by the members' wealth and trading volume, with more prosperous members expected to contribute more to the collective fund. In addition to regular dues, the guild collected entrance fees from new members, fines levied on members who violated guild rules, tolls on certain categories of trade conducted within the guild's jurisdiction, and payments from non-members seeking to trade under specific licenses rather than as full members. This combination of income streams gave the guild a reasonably diversified revenue base that was more resilient than any single source alone. The treasury funded the guild's ongoing expenses, which were more substantial than a purely social organization would require. The guild maintained a hall, often a genuinely significant building that served as the center of commercial and social life, where meetings were held, disputes were resolved, accounts were kept, and ceremonial functions took place. Maintaining that building, staffing it with whatever administrative function the guild required, funding feasts and religious observances that were genuinely important to the guild's social cohesion, paying for legal expenses when the guild needed to defend or enforce its charter rights, and supporting members who had fallen into poverty or illness through the guild's charitable obligations all represented real, ongoing costs that the treasury had to sustain. The charitable dimension is worth pausing on because it is easy to dismiss as merely ceremonial, but it actually served an important economic function within the guild's own logic. A guild that allowed its members to face destitution without support was a guild that undermined the sense of security and mutual obligation that made membership valuable in the first place. If joining the guild offered commercial privilege, but no protection against catastrophic personal misfortune, the case for contributing honestly to the collective treasury was weaker. The charitable function, supporting widows of deceased members, providing relief to members who had suffered fire, flood, or other commercial disaster, contributing to the burial costs of impoverished members, was partly genuine communal solidarity and partly a calculated reinforcement of the membership proposition. You paid your dues because the dues represented not just current commercial advantage, but a form of insurance against future catastrophe. The regulatory function of the guild was where its economic impact on the broader market became most tangible and most contested. Guild wardens, elected from among the senior membership, had authority to inspect goods being traded in the market, to condemn and confiscate goods that did not meet the quality standards the guild had established, and to fine or exclude members who violated trading rules. In the wool trade, which was one of England's most economically significant medieval industries, guild regulation meant that bales of wool presented for sale were subject to inspection for adulteration, for fraudulent weight, and for misrepresentation of quality. The guild warden who condemned a bale of fraudulent wool was performing a genuine market function, reducing the information asymmetry between buyers and sellers that would otherwise have made large-scale trade far riskier and therefore less extensive. But the regulatory function was also a mechanism of competitive exclusion that served existing members' interests directly. When the guild set quality standards, it was also setting barriers to entry that made it harder for new competitors, whether local aspirants who had not completed the full membership process or outsiders seeking to penetrate the local market, to participate on equal terms. The line between genuine quality regulation and protectionist exclusion was genuinely blurry in practice, and guild wardens were not independent arbiters operating in the public interest. They were elected representatives of an organization whose members had a direct financial stake in limiting competition. Understanding this tension is essential to any honest analysis of what guilds actually did economically, as opposed to what their own charters and ceremonial language claimed they did. Credit and debt management within the guild system is another dimension that tends to be underemphasized in popular accounts, but was commercially central. Medieval trade across any significant distance was not typically conducted in immediate cash payment. Merchants bought goods on credit extended by suppliers, sold goods on credit extended to buyers, and managed the resulting web of receivables and payables across trading cycles that could span months or even years. The guild's institutional role in this credit system was significant because guild membership provided a form of reputational collateral that made credit extension between members considerably safer than it would have been between strangers. When a guild member extended credit to another member, they were extending it to someone who had a known reputation within a defined community, whose assets and trading relationships were broadly understood by other members, and whose failure to honor a debt could result in guild sanctions, including suspension or expulsion, with the associated loss of all membership privileges. This meant that membership functioned as a form of implicit guarantee that reduced the risk premium embedded in commercial credit transactions between members. A merchant in London extending substantial credit to a wool merchant in York was taking considerably less risk if both were guild members whose standing within their respective guilds was known and could be verified through the guild network. This credit function becomes even more important when you consider the scale at which major medieval English merchants operated. The wool trade, in particular, involved transactions of genuinely large value, with English wool exported to the cloth-making centers of Flanders and Italy in quantities that required sustained, large-scale credit arrangements between English producers, English merchant exporters, and continental buyers and bankers. The guild network provided an institutional infrastructure that made these transactions manageable in an era before banking in the modern sense existed, before commercial law was developed enough to provide reliable contract enforcement, and before the state had administrative capacity to resolve commercial disputes efficiently across jurisdictions. The relationship between guilds and the towns they operated within is another layer of complexity worth examining carefully, because the guild was not the town government. But in many medieval English towns, the two institutions were so deeply intertwined as to be practically inseparable. The most successful merchants, the men who dominated the guild's leadership, were typically also the men who held the town's most important civic offices, serving as mayors, aldermen, and members of the various councils that governed municipal life. This overlap between commercial and civic authority was not accidental. It reflected the reality that in a medieval town, the guild's economic interests and the town's fiscal interests were largely aligned, and that the men with the most commercial experience and financial resources were genuinely the most capable administrators of the complex financial and logistical challenges that medieval urban governance presented. But this alignment also created genuine tensions and genuine abuses. A town government dominated by guild merchants had obvious incentives to use civic authority to reinforce guild commercial privileges, to direct public infrastructure investment toward projects that benefited guild trading activities, and to apply tax and toll systems in ways that disadvantaged non-guild traders and favored guild members. The poor and the craftsmen who were not full guild members were governed by institutions whose leadership had structural reasons to prioritize the interests of wealthy merchants over broader urban welfare. This tension was a persistent source of social conflict in medieval English towns, and the periodic urban revolts and guild reform movements that punctuate medieval English history were often at least partly driven by resistance to exactly this kind of institutional capture of civic governance by a commercially privileged minority. The international dimension of the most successful medieval English guilds adds a further layer of economic sophistication that is easy to underestimate. The merchants of the staple, who held the royal monopoly on English wool exports through the designated staple towns, operated a system of commercial control and fiscal extraction that was genuinely elaborate by any standard. By concentrating the export trade through specific ports and towns, the staple system allowed the crown to tax the wool trade efficiently, the merchants to maintain market control and price discipline, and the Italian and Flemish buyers to deal with an organized, accountable counterpart rather than a fragmented and unreliable market. The staple merchants managed the relationship between English wool production and continental demand across an international supply chain that spanned the English countryside, the port towns, the Channel crossing, and the market halls of Bruges and Florence. This international operation required the guild to manage a set of commercial, diplomatic, and logistical challenges that were genuinely complex. Exchange rate risk between English sterling and continental currencies had to be managed. The credit risk of continental buyers had to be assessed. Diplomatic relations with foreign governments and foreign merchant communities had to be navigated, often in an era of intermittent warfare that disrupted trade routes and complicated the legal enforceability of contracts across jurisdictions. The Guild as an institution provided the organizational infrastructure that made this international trade possible at scale, and the merchants who led those institutions were, by the standards of their era, genuinely sophisticated commercial operators. If this kind of serious economic history is the kind of content you want more of, follow Money Framework British and turn on notifications so you never miss the next breakdown. The decline of the medieval merchant guild as the dominant form of commercial organization is itself an economic story worth understanding, because institutions that appear permanent rarely are. And the guild system was eventually undermined by exactly the competitive forces and institutional developments it had for so long suppressed. The growth of royal administrative capacity meant that the state gradually became able to provide some of the functions: contract enforcement, commercial regulation, dispute resolution, that the guild had previously supplied privately through its own institutional machinery. The development of more sophisticated commercial law and eventually the common law courts as accessible venues for commercial dispute resolution reduced the guild's unique value as a dispute resolution mechanism. The expansion of long-distance trade beyond the guild's local or regional jurisdiction created commercial relationships that the guild's geographically bounded authority could not easily govern or regulate. The rise of new forms of commercial organization, particularly the joint stock company that began to emerge in the 16th century, offered a way of pooling capital and managing risk across large commercial ventures that was more flexible and more scalable than the guild model. which was built around individual merchants operating within a collectively regulated framework rather than around shared ownership of a business enterprise. The East India Company and its contemporaries represented a fundamentally different model of commercial organization that the guild system, built for a world of local market regulation and bilateral credit relationships, was not designed to replicate. By the time the Industrial Revolution was reshaping the British economy in the 18th and 19th centuries, the Merchant Guild, as a genuinely economically powerful institution, had already been in decline for 2 centuries or more. Gradually hollowed out as its monopoly privileges were eroded, its regulatory authority challenged, and its membership proposition weakened by the development of the market and legal infrastructure that had once made the Guild's private provision of those functions so essential. What remains genuinely remarkable about the medieval Merchant Guild, looked at purely as an economic institution, is how much it accomplished within the constraints of its era. It solved, imperfectly and self-interestedly, but genuinely, a set of market failures that were otherwise genuinely severe obstacles to sustained commercial activity. It provided information through reputational networks that allowed credit to flow between strangers who had a common institutional bond. It provided enforcement through the threat of exclusion from commercially essential privileges. It provided quality assurance through inspection and certification systems that reduced the information asymmetry between buyers and sellers. It provided capital pooling through treasury systems that could fund collective goods no individual member could afford alone. And it provided political influence by placing commercially sophisticated men in positions of civic authority where they could shape the regulatory environment in which trade took place. That it did all of this in ways that also served the narrow interests of its membership, excluding competition, extracting rents from outsiders, and capturing civic institutions for private commercial benefit, does not negate the genuine economic functions it performed. It simply reflects the reality that economic institutions are rarely purely public-spirited constructions. They are built by people with interests, and they serve those interests alongside whatever broader social functions they provide. The medieval Merchant Guild is, in that sense, not so different from the commercial institutions of any other era. It simply operated in a world where the functions it provided were scarcer, the alternatives were fewer, and the consequences of its exclusions were more directly and immediately felt by those left outside its walls. If you want more deep dives into how economic institutions really worked across British and world history, follow Money Framework British and turn on notifications so you never miss the next one.